SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF-Baffi Bocconi e-lecture on the topic towards macroprudential frameworks for managing climate risk. There are indeed many indicators that can measure threats which climate change poses to financial stability. The macroprudential challenge is to bring these indicators into a coherent surveillance framework for managing risk. A recent paper by the ECB and the ESRB groups a growing body of evidence on indicators into three primary categories: climate shocks, exposures to these shocks, and financial risks resulting from the interaction of exposure and prevailing vulnerabilities. The paper argues that existing evidence can be used to tailor a macroprudential strategy to contain risk for banks and for the broader financial system. We're very pleased and privileged to have with us today Paul Hiebert, Head of Systemic Risk and Financial Institutions Division of the European Central Bank. Paul will present key findings from the ECB ESRB report. Then, Irene Monasterolo, Professor of Climate Finance at Utrecht University and SUERF Fellow, will offer a first set of comments. Irene will be followed by Pierre Monnin, Senior Fellow, Council on Economic Policies, giving a second set of comments. Without further ado, over to you, Paul.
Thanks so much, Ernest, and thanks for the opportunity to share our work with you today. There was a report we published indeed last December. You nicely already summarized, I think, its contents. And I say the report is reasonably comprehensive. So it's over 150 pages with annexes and chart books. I don't intend to keep you here for 8 hours, though I easily could. Rather, I'll try and give you effectively a 30,000-foot helicopter tour, as they say. A bit of a taster of the contents. There's footnotes, references throughout to show you where to access the information. But I think best to give a sort of a broad sweep of what's in the report. And with that in mind, I'd maybe just give a very short background. We've effectively, this all emanates from work of the Euro system. So the countries which are part of the common currency, the Euro, but also the EU countries more broadly in the context of the European Systemic Risk Board, which nicely groups together not only all of the member states in the EU, but also the supranational regulators, if you will. So that's EBA, EIOPA, ESMA, that are dealing with, of course, banks, insurers, and markets. But also we have the European Commission there, which has been very helpful because they have a lot of environmental expertise, notably in ISPRA, where they have their research center. So with this in mind, that's been really helpful to basically do what you've already described, Ernest, in your intro remarks, yield a positive measurement, evidence, if you will, of what climate change will entail for financial stability. And I think our challenge was, as we've established this group back in 2019, which we were having an accumulating body of evidence which needed to be actually put into a framework which could be scaled up as more evidence comes into play and also make sense of the evidence we've collected so far. So with this in mind, that is the effective raison d'etre of the group. What is true is that it turned out then this evidence as such, which we know in this report have put into first a financial stability surveillance framework, which has the elements you've already listed out. So climate shocks, exposure to these shocks, and risk. Also, what we've tried to do with time is also look at systemic amplifiers. Since we are ostensibly a macroprudential outfit looking at financial stability, risk might not be additive. It might be also a function of the interplay of different parts of the financial system and the real economy. So that's where we've also invested quite a bit. So that's the first block I'll go through in this presentation. The other two blocks, as you rightly point out, is we take this evidence, leverage it to try and inform what could constitute a macroprudential response to climate change. Should be the second thing I'll go through. And in the third one, I'll just give you a broad look at the elements which effectively go beyond the climate into nature-related risk and ask what might be want to consider in that respect as we move work forward to try and have a more holistic view. And I think holistic has been at the heart of everything we've been doing thus far with a macroprudential add-on. With this in mind, let me start with the first block, which is the financial stability framework. And Ernest, as you already said in your intro remarks, it has these three different components. The first is going to be about climate shocks themselves, shocks that can destabilize financial stability, either on the side of transition risk or on the side of physical risk. And obviously there are interdependencies. Two is this idea that you would have exposure to climate change. So this orange block we have here, and that's going to be much more exposure to the real economy, and there's also the financial side. And here you see some examples listed of the types of indicators we could go through. I won't go through all of them, but the types of indicators you'll find in the report and the annexes in the chart book that are effectively designed to capture these exposures to climate shocks. And third, most importantly, perhaps for financial stability, is a forward-looking view on risks. You have the exposures in place. How do you project this forward and understand how they could involve financial or real economy strains, which feed back into losses for the financial system? And of course, systemic amplifiers being a big part of this when it comes to systemic risk. So let's dig into this and look at the first block. I'll try to be relatively brief on the first block, as I think many of the elements are known, but I think for the purpose of exposition, some are relatively interesting perspectives we could take on this risk. And I'll present three indicators on physical risk and one on transition risk before we move to the next block. On the side of physical risk, I think what has to be, of course, understood is that 1.1 degrees of warming on the planet is already in the baseline now, today. So it's not a risk, it's actually a baseline outlook. Anything that comes on top of that is a risk. And what that means is by the end of the century, we will have hotter temperatures, substantially hotter in Europe here, like elsewhere. And if you look at the map on the left, it's just giving this idea if we're in one of the worst scenarios, which is current policies, interestingly, is actually the one that's probably closest to baseline, is effectively giving us the idea that we would have very high temperatures in Southern Europe, you can see in this map, but also across the board throughout most of Europe on average throughout the year. And the interesting part, I think, is to look at what would that appear as when you look across the euro area countries. So the right-hand side chart, we have according to each scenario. So the one which is the most ambitious in terms of emissions reduction still gets us to a warmer scenario in these blue triangles, which is substantially warmer, particularly in the Baltic and Nordic states, which are further north. As we know, as you move further northward, the more amplified are the temperature increases we'll see, which are on average throughout the globe. And what we see is those temperature increases are enormous. If you move out to the worst case scenario, where we have current policies are not really amended to account for climate risk reduction, we're looking at upwards of 10 degrees warmer temperatures by the end of the century. So clearly, these risks are effectively baked in to a varying degree, and it's now about containing that risk. What's important, I think, to note, and this is that it's not just acute physical risk we've been already seeing so far. Droughts, wildfires, flooding. It actually is the chronic risk starts to be more and more of a concern as we move forward. And what are the signs of that? Well, mainly sea level rise. So sea level rise, interestingly, if you look at the anomaly of global sea temperatures, we see those are already rising to above 0.8 degrees. 70% of the world's surface is water. And this really is a substantial warming for that body of water, which is effectively what's forming our oceans. So clearly with that sea level temperature rise, it's going to be rising sea levels. It's going to probably be contributing to the mix. So it's not just acute, but also chronic risks. And part of that, of course, and parcel of that is this idea that you have these polar ice sheets, which are disappearing. In the Antarctic, we're talking now about 2 million square kilometers last year, effectively as the anomaly compared to the 1990 reference value. So clearly, we have to be worried about these elements also adding to the physical risk shocks, which means that they're on a scale we've probably not seen thus far. And it's hard to use the past as a guide. And in fact, if you think about it, we are actually in the range already now, not with further warming, now with today's warming, in the sphere of tipping points, these so-called tipping points. And some of them we're already seeing in terms of ice sheets I talked about, but also this idea about convection. So in the North Atlantic, for Europe, which matters quite a bit, you have an oscillation of saline water meeting fresh water based on ice melts. And this can also imply you have also changing currents, but also substantially changed temperatures. And these things obviously can get much worse if you move into other elements where you have further warming beyond what we already have now, into tipping points which start to compound. They may mean you might face quite some climate shocks on the physical risk side. Now, I think the other thing to note, apart from physical risk, is on the transition risk side. The salience of these shocks, which I hope you'll appreciate so far from the physical risk side, could become more important. It's also going to be there on the transition risk side as we start to see backloaded commitments for 2030 for many parts of the world, including Europe. I say backloaded, but I mean somewhere effectively action has been taken, but much of it was still foreseen for later in the decade, is yet to come. That said, of course, if you look at an NGFS net zero transition, so one which we would tend to think about as the most sort of the best, if you will, for financial stability, that orderly action is taken soon and on a sustained basis. we'd expect that the share of renewables, this green block in here, to already double next year, not a few years hence, next year, in the energy mix. Admittedly, that seems a bit difficult to imagine at the moment, but if you even look at the Fit for 55 package of the European Commission, by 2030, we'll also see almost effectively a doubling of the energy mix compared to the 2020 levels. So effectively, and by 2050, a huge energy transformation. Now, I think what's important to take from that is that transition risk is likely to contribute. This energy mix switch is going to only gain pace as we look forward. If you look at the right-hand side chart, the other thing to notice, I think it's important to underscore, is that across European countries, the pace with which this will occur is also going to differ. And it depends largely on a starting point. So Germany, you see here, has a large increase foreseen by 2030 in renewables. On the other hand, Netherlands has very little. And that's effectively, they've got more transition that comes after 2030. Whereas in France, nuclear is always going to be very resident in the energy mix. So the starting point really matters and starts to condition how you think about the possibility of transition shocks across countries. I think it gives us pause for shock that the thought that the shocks which will come from climate are probably going to have a common component, but also some country-specific or regional components too. Now, with this in mind, I would move over to the exposure side, noting that climate shocks are likely to become more strong. What is the actual assessment we would have of economic and financial exposures? And let me kick in first here with the idea about physical risks. So what we see thus far is when we take 20-year ahead projections of Moody's 427, so one of the private providers, there are many, they give us the element of what would climate risk look like on the physical risk side over the next 20 years. We see that some elements like floods, these blue dots tend to be much more resident in Central and Eastern Europe. Wildfires, on the other hand, much more resident in Southern, Southeastern Europe, if you will. So clearly the type of hazard which will be impactful will be rather different across regions. And even within countries, these dots are each address level. So we have around 4.7 million firms worldwide and 3.3 million firms in the euro area here, geolocated. And that tells you in a very specific way, what is a productive capacity which could be also potentially impacted in a significant way by climate change. And you can see it could be quite widespread, but also quite regional. So there's concentrations which are clearly there. And the right-hand side chart, which is just something we pulled out as we've gone along in conjunction with our insurance supervisors, is that we see that the provision of insurance today, not in 10 years, not later on, is already quite limited. 25% of climate-related hazards are currently insured. And that goes down to 5% in some jurisdictions in South and Southeastern Europe, leaving a lot of the climate-related hazards uninsured. And of course, with time, we would expect that premiums will probably rise and insurance coverage will probably fall as we see the incidence of physical risk shocks. So clearly something needs to be done here. With respect, we will come back in this in the policy block to some thoughts we've had on this. With insurers, probably quite key custodians of physical risk management. Now, if I move over to the side of transition risk, banks tend to be the key custodians here. So what we see is that banks tend to have a fairly high exposure to high emitting firms. But of course, what's important to think about finance emissions in banks is that there's no unique measure associated with this. And I list in the table here at least 4 you could consider. So one is weighted average carbon intensity. So how much exposures do banks have via loans and securities normalized by the outstanding volume of each. The second is about tilt. And I'll come back in a minute because that's the chart you're going to see on the right. The third would be about taxonomy alignment. How are the actual investments associated with effectively the greener, if you will, in absolute terms, in terms of shares of holdings, the alignment. And I think last is the idea of bank level risk. Would you expect also that certain banks are more prone to climate risk and therefore need to be looked at more closely? Now, this tilt measure, I think what's quite interesting to take out of this one here, if you look across the sectors, banks tend to be overweight in their lending in areas like real estate, energy, transportation, and agriculture. These are going to be traditionally parts of banks' lending portfolios. And maybe a bit more underweight in terms of communication, scientific, health, education, public sector. What that amounts to is that bank financing ultimately is around 73% more emissions intensive in economically, if you will, in sectors of the economy which have a higher climate intensity than others. So these yellow bars, these loan shares tend to be quite a bit higher than the gross value added shares in these industries I mentioned. So with this in mind, and the intensities you can see in the red dots here, suggests that banks will need to manage this down. And that's, I think, one key area we're watching as we go forward. That's on the side of firms. On the side of households, I think what we've done in this report is dig more deeply into survey data. We don't have as granular data, unfortunately, for households. But based on energy expenditure data we have in households with some other ancillary data sets, we can come up with CO2 emissions for households and map them into mortgage lending. As we see on the right-hand side chart here, is by country, how emissions intensive is mortgage lending. And what we see effectively is that many of the countries here have quite a big share, from 60 to 80% of their mortgage portfolio is in high emitting households. Again, needs to be managed down. It is quite heterogeneous across countries, and maybe it's a bit broad brush to give you the countries here, but that's the best we can do with survey data. And in effect, then that's going to mean also potentially the exposures on this side of households could be substantial. Now, with the exposures behind us in firms and households, let's look a little bit more at risk, because I think this is a lot where the action is for us in financial stability. How do you take these exposures? I think in a forward-looking perspective, where would I manifest in financial stability relevant risk? With this in mind, if I go here to the idea of what actually underpins much of what we do on the risk side is really fundamentally about scenarios. No matter how you cut it, you want to get a forward-looking view. Of course, the traditional ones tend to be NGFS scenarios where you say the best possible world is I minimize both transition and physical risk. Because there is, of course, this trade-off, more transition risk, less physical risk, with a steady and orderly and upfront adjustment. Now that starts to look a little bit more distant, as we're not seeing that having occurred over the last years in earnest. So effectively, we could have either delayed transition becoming dominant. We have a lot of action as we approach 2030 or clear milestones in a more abrupt way, or current policies which bring us to very warm temperatures that I already noted. Now, what we've done various exercises related to this. We've had a cost-benefit big 30-year exercise. It's linked here in these slides. We also had a bottom-up one, which we had the SSM banks also work on this data and have a look at what they see in that side, not just top-down, if you will. And what's I think important is we've increasingly in last year looked at also the prospect of digging into the shorter term. 3 to 8 years versus 30 years. This is an actionable, more actionable horizon. What's going to happen over that time frame when we probably have more, political, financial focus on these years, maybe not 10, 20, 30 years hence, which are very uncertain. Because you could have a late push transition or an accelerated transition as two sort of subsets, if you will, of getting to 1.5 degree scenario, but maybe in various ways, backloading or front loading your adjustment, if you like. And that's in this 2023 reference. I think these are all references one could dig into. I won't get into a lot of detail, but I think what's important to note is this fourth one I've listed in the bullet here, is system-wide considerations. And that is something I'll dig into now. It's just that what could be amplifications or compounding, which means that some of the numbers we've seen thus far, which on aggregate don't give us shocking figures, although there's a lot going on under the hood in the sectors, maybe underestimating the scope for risk to materialize. The first element I'll focus on here is the idea that you could interact shocks. So if a transition occurs in a smooth and positive, so you will, base case economic environment, that's one thing. But what if it were to occur, maybe involuntarily to some extent, because you're adhering to climate commitments in the context of actually a more challenging macro-financial backdrop? So here you could take the European Banking Authority's adverse scenario, at least for the next years, layer in some climate risks there, notably sectoral impacts, and also the investment shocks needed to bring, if you will, productive capacity to a greener side. And think about the prospect of that as an amplifying feature in an adverse scenario, adverse environment. And you could layer on even additional uncertainty, if you will, that could also exacerbate challenges. And what we see in the right-hand side chart is some work that the Bundesbank colleagues have done with us in this, is that they saw that fossil fuel, mining, and quarrying sectors tend to have a direct transition risk shock, which is quite substantial compared to their peers. Understandably, energy transition will front and center involve them in their transition. But what we see is this transition under adverse conditions can also add to the pain across the board. So it may not be that particular sectors are only worthy of examination, but you might need to think more broadly in an adverse scenario about potential broader challenges. And of course, this uncertainty shock could be particularly significant for those sectors facing the need for a greatest transition sort of intensity. I think the other amplifiers, I'll list three, which I think are more, if you will, conceptual with a few applications, to give you an idea of what could mean that we have actually larger shocks than we've been witnessing so far in a few ways. The first I look at is economic spillover. So, of course, Europe is a very open economy. And if you take the fact that we have effectively exposure to many global regions through global value chains, which is this effectively this nice map I've shown you here of all of these links, You could add in numbers that we picked up from the private sector, S&P global data on GDP at risk, and just see that how much GDP at risk through these value chains could translate into loss. And the way the window which we looked at this is actually apparent in the right-hand side chart here. We see Europe, so let's take the euro area, EA here. The light blue bar tells you how much direct climate loss you might have from physical risk, relatively limited compared to other regions of the world. That said, because we trade so actively with the rest of the world, and we have a very open economy, if you were to build in effectively the trade links, you could see an amplification of this, which is substantial, depending on the elasticity of substitution across jurisdictions. Can you easily move across jurisdictions your trade and reallocate frictionlessly or with frictions? And this gives you a bit of a range, if you will. Now, the numbers here are quite big, and the reason is we're factoring the worst possible scenario with correlated shocks across all regions, which of course is maybe going to be one of the worst case scenarios. But I think still at the same time, it gives you a flavor of the type of amplifications we may see, and where some regions might have direct climate shocks, which are very large, and they're hard to actually diversify away from. So we have to think carefully about managing these risks. The second amplification is going to be actually more financial, which is the idea is you would have potentially overlapping holdings. So as we hear from the financial industry, well, we have relatively short horizon maturity holdings, if you will, on the asset side of securities or loans. We'll just effectively manage those when the time comes. Well, that seems like a very heroic assumption if everyone's rushing for the exit at the same time. So one of the things we've been looking at is cross holdings. What proportion do you see in terms of across sectors in the financial industry? These cross holdings highest. Banks tend to be actually quite unique in terms of their overlap, but if you will, in the investment fund sector or insurance corporations tend to have a very high overlap with respect to other peers. So in this respect, we might expect to see correlated setting actually lead to meaningful price impacts, which are not always accounted for in standard stress tests. Last systemic amplifier is risk transfer. And I think this is a particularly important one for physical risk. If you will, that insurance coverage gap I mentioned earlier, the protection gap being quite large, around 75% of climate hazards, under or uninsured in Europe, could mean the sovereigns want to step in. And politically, of course, the temptation may be very large, for humanitarian and other understandable reasons after disasters. But that can, of course, relate to then some feedback mechanisms where sovereign debt also itself becomes somewhat impaired. So this in mind, these things, in our view, all three of those elements may not be fully accounted for by existing exercises, give us pause for thought on financial stability. As you go forward, we need to understand them better, to understand the ultimate impacts of climate change and financial stability. And with that in mind, let me do a bit of a shift from the evidence we gathered, which I presented thus far, and move over to how would we actually inform then macroprudential policy options based on this. So a different block now entirely. This block effectively starts with the idea of what is the rationale for macroprudential policy. I think it won't surprise you, it's about market failures. Environmental economics textbooks are always rife with this. In this respect, you can think about classic systemic risk channels, spillovers, nonlinearities, interconnections. I've talked about some, but also think about climate's unique features. The concentrations I've already shown you tend to be in a physical risk very regionally concentrated, transition risk both across and within industries and the firm side. And you also there's the idea that there's a reversibility, at least based on current technologies, of climate-related risks. And this idea that the risk buildup may be underpriced. So with all this in mind, of course, macroprudential policy is a natural case for it, no? In terms of resilience, if you will, in terms of risk buildup, and in terms of complementing and having a system-wide perspective on the basis of other more targeted macroprudential exercises. And still on the macroprudential side, of course, it's going to be a holistic view needed. You need both micro and macro to make this work in a prudential space. And of course, it's about managing institution-specific idiosyncratic risks, but also managing this feedback, if you will, between the financial system and spillovers feedback loops, but also with respect to the economic system. So I think there will be, of course, along the way complementarities, but maybe also conflicts, where the micro and macroprudential supervisors don't always agree. And that's going to require just a lot of dialogue as we move forward. And that's something we're hardwiring, of course, into our particular work. Now, as I move forward, maybe into a general strategy, which would then follow from this. On the macroprudential side, what we see is a robust strategy, which you could scale up as you have more access to other instruments or elements, but the one which is effectively at least classifies the type of policy tools we might employ. Here I list three. So 1, 2, and 3, you see listed on top. The first is going to be oriented towards banks. It's key custodians of transition risk. And you can think here about managing absolute risk, so the risk across the economy, versus relative risk, given these concentrations are quite strong, which might be resident in part of lending or securities portfolios. And I'll talk about some of the elements, as you see below, which could constitute some potential approaches you could take in the existing instrument set to tackle these, both capital-based and non-capital-based. The second block will be about borrower vulnerabilities. So that's about the real economy, if you will, loan to value, debt service to income. It's about managing the flow of risk, maybe less so in the stock of risk on the balance sheet of banks. And that, of course, can be a powerful complement. I'll come forward on that one too in a few slides. And last but not least, of course, the non-bank financial intermediation sector, both insurance and the broader energy, the non-bank financial intermediation market, will be the ones which will be, of course, ones we want to look at in this respect. So let me start with the first block, go to the second, and go to the third in terms of illustrating what policy options might be there. Some of them are listed in this broad table. On the first one, of course, there's always the perennial question, do we need more capital to deal with climate? And I think that's an open question still, but to be fair, what's true is that if you look at the average of losses over the historical period, and this is just very illustrative, this little chart we have on the right, but I think what one can ask conceptually is, will you have higher average losses or average volatility of losses from climate? And I think most of us would tend to think at least the latter will hold true, possibly both. With that in mind, banks can provision against climate risk. Probably they'll need to hold additional capital for what is unexpected. That's a shift in the distribution, if you will, for unexpected losses that come from climate and are not fully catered for. And of course, one has to be careful with this because transition finance is important, and banks will be also custodians of managing that transition to finance missions downward and not just trying to exit from these exposures, effectively creating economic shocks, but also moving it elsewhere in the system without management. So obviously, it's not maybe a question about if capital requirements are required, but maybe when and how. And we can get around to that in the discussion, but let me just go forward with maybe a very specific application, which is that of a systemic risk buffer. So it's one of the tools in the instrument set, which it seems to be particularly amenable to dealing with climate risk. Now, I'll not dwell on this slide much. You see a study listed here, which goes into a lot of detail on this measure, and I think it provides a very, very interesting exposition, just how you would actually practically organize a buffer. You'd have an adverse scenario in a forward-looking stress test compared to a baseline, and you might also map it into buckets, which you could apply. But let's not get into the details, but rather look at the conceptual element first. Again, if you have a look at across the capital spectrum, would you apply it in terms of granularity to all banks or only some banks? In terms of scope, would you apply it to all the exposures they have or only some exposures? So it's the X and Y axis here. What you see is here that supervisory measures are very granular, very targeted. That's what supervision is effectively looking at, trying to contain in a very, I think, finely tuned, fine-tooth comb way, which I think is a real advantage of supervision and macroprudential measures. Of course, a macroprudential measure in its very extreme form would be apply a single buffer, a systemic risk buffer to the whole system, all exposures. Admittedly, probably the truth is in between. You'd probably look at applying to a subset of banks with more concentrations, given concentration is a key issue, and maybe not to all exposures, but to maybe some exposure combinations, climate risk combinations you particularly feel are concerning from the perspective of unexpected loss. In this respect, we might want to think using this instrument flexibly, not in a brute force way, but rather in a way which is refined in terms of the banks it covers and the exposures it covers as we move forward. The right-hand side I won't talk much about, but it's an element of illustrating how you could calibrate this. And based on a calibration factor, which tends to be very common in these types of measures, you could also imagine how many banks fall within and outside the scope of a concentration type based look at the systemic risk buffer application and how many would actually face higher capital requirements, depending how stringent you are on employing this, again, with a transition finance notion in mind. I think the other way to look at this question is not capital based, but rather concentrations. What if you actually focus on concentration measures and say, I want to bring down egregious concentrations to levels which are a bit more manageable so that no one bank will face particularly high losses. And that could actually result from the studies we've been doing in a potentially significant reduction in transition-related losses. So if you go above the 75th percentile and bring that back to 75th percentile, losses do fall quite a bit across the years. What's true is in all of these, and this could trigger then, of course, it's not a capital-based measure, it could trigger enhanced supervisory scrutiny, or even, if you will, a capital-based measure at the end. But it's an alternative if one thinks we don't need capital here as a sort of brute force instrument, but rather come back and think about potential concentrations to bring us back to the idea of transition finance and management. Now, lastly, I talked about borrower-based measures. I think this is a fairly clear elucidation of the fact that borrower solvency or collateral value can be impacted by climate change. It probably is a default or loss given defaults are impacted. Loss comes from obviously the interaction of the two. And what type of measures you might consider as a flow complement to the stock of dealing with banks' balance sheets, unexpected loss component. And that could be, again, debt service to income, debt to income, or loan to value limits. On the one hand and the other hand, depending on whether you want to focus on probabilities, the losses different. It's got a very powerful complement. Now let's, before concluding the macroprudential part, briefly talk about insurance. I've put a lot of emphasis in the first block about insurance protection gaps. One of the things we've been thinking here about is working with our insurance supervisors, and here it's been very much joint work with the OPAS, or insurance supervisor here in Frankfurt, is that we were thinking about a ladder that could be in effect. If you have insurers which are very good at managing diversifiable risk, systematic risk, can deal with this if you have the ability to diversify. Of course, systemic risk is more difficult because it tends to be correlated shocks which are not diversified. If you move up across this ladder, you can see in the best case scenario, high frequency, low impact shocks are well managed by the insurance sector, is what they do. But if you're having difficulty with finding diversification benefits when you have correlated shocks, you could move up to reinsurance or pools, or encourage private market development and catastrophe bonds. Markets have been much less focused on risk management than they have on opportunities so far. And kickstarting these markets could help also bring out tail risks, if you will. The last two levels are ones about thinking the sovereign might have an interest in limiting its liability to climate-related risk when it materializes. So why not work with the insurance sector ex ante to also figure out what's covered versus what's not, rather than having constructive ambiguity exposed and effectively maybe translating into a blank check. And this, I think, it needs to be considered because sovereign risk could be one which is significantly challenged by widespread incidents of physical risk shocks. So this mind is just, and of course, the last level, you could bring it up to the EU level in case national member states are also having trouble with diversification. It's just an idea of organizing or thinking around that. Of course, much of the work still is yet to be done, but I think it's important branding that work. Of course, the last thing before I leave this block is just informational market values are still clearly there, even if you don't talk about allocated market values. And a lot of work is underway. I won't list it in detail. It straddles, of course, micro and macroprudential elements. But the idea is we need more information in terms of the quality, the quantity, and the effective reliability of data as we move forward. And there are many initiatives underway, and they will bear fruit with time. In the meantime, we really have to, of course, be mindful of this. Now, just to close out, and I'll be very brief on this block, is that I've talked so far exclusively about climate. But of course, one of the things we were looking at this edition is maybe there's broader links to nature, which we may need to be mindful of when thinking about the perspective of potential amplifications. And here I just very briefly go through what we've seen on nature-related risk. So far, we've again come at this with the mentality of let's have a conceptual approach, a framework, but also try and give some initial numbers on exposures and quantifications. So let me do both. And first, on the conceptual side, nature is a bit harder to define than climate. It's not about temperature warmings, if you will, in emissions per se, but it's about a broader set of elements, which are so-called ecosystem services. Services provided to the economy. If you're thinking, again, beyond utility we get that are non-economic, non-financial. On the economic and financial side, there are dependencies, if you will, on ecosystem services. Two branches. Water availability is key. Groundwater, surface water, but also the flow maintenance and quality. Think not just here about agriculture or even manufacturing, where you need a lot of water for many processes, but even data centers, services need a lot of water for cooling. So water is core. Biodiversity, on the other hand, again, is important in terms of soil quality. And when you think about mortgage financing being big on banks' balance sheets, that could be an element which, of course, could be quite relevant for banks. You know, the idea of soil quality is getting worse. You have also effectively droughts drying up and also deluges of rain. That's one thing we know about climate risk going forward. Now, with this in mind, of course, nature and climate therefore have a natural link. I won't go through them. The slide's quite self-explanatory. But note rather, what could we see in terms of a framework then to deal with nature? And you'll see many instances here where it's very close to climate. That's how it's organized. That is, the nature, as I already mentioned, nature-related risk is much broader than climate. You can see some of the elements here. But nevertheless, elements it feeds into are actually quite similar to what we're looking at climate, that there's a physical and transition risk side, like there is in climate. There are economic risks associated with these, which are micro and macro both, and some feedback effects among them, very similar to climate. And lastly, they materialize in general categories of financial risk we're familiar with: credit risk, liquidity risk, operational risk, market risk, if you will. So all of these elements give us the idea that there is a possibility to look at nature similar to climate in a way which is rather structured. I think what the key thing that we did, and that was all work so far we did in conjunction with the NGFS, we're also looking into this, is to think more about what are the actual numbers we can attach to these risks. So on the side of banks or insurers, so on the left-hand side, right-hand side, we look through these various elements of nature-related risk and ask, what are the dependencies there are in ecosystem services listed here, both direct and also upstream in the value chain. And what you see is for banks, elements like mass stabilization and erosion control against soil quality matters a lot because of the nature of mortgages or agriculture lending is quite strong. But also surface water, groundwater, again, get into manufacturing, different parts of the economy require a lot of water-related elements. And they're quite important, actually, if you will, in terms of ecosystem service scores, maybe more so than pollination, nursery habitats, elements like this, which are a bit more distant. So it gives you an idea of what would be the more relevant potential challenges. These are only exposures, not risk, that we could worry about. And here about, if you take the totality of this, it's around 75% of bank loans have a high dependency on at least one of these services. So it's not a small number. Insurers, similar. I think the only differences here is around 31% of insurer investments have this high dependency, unlike banks, 75%. And that it tends to be more water focused, surface water, groundwater, flood, and storm protection. So again, exposures, not necessarily saying these are amounting to risk, but just something we may want to be aware of as we think about climate in a broader manifestation. Now, mindful of the time, I know it's been a lot to absorb, but I hope that you'll have the chance to read through some of the report in your spare time, at least. And what I can do is just give you a broad summary then of what I've shown you today. First, these three blocks, of course. And the first one's on financial stability surveillance. The 4 points that came out. One was this idea of climate-related shocks becoming more salient with time and likely to do so in the next years, maybe faster than we think. Two is that financial exposures there tend to be concentrated. And they're concentrated in many ways listed here, regionally, sectorally, firm level. And granular assessments then and granular approaches to dealing with these risks may be helpful. Third, financial risk could ensue, but it'll probably be bumpy. It's not going to be relatively smooth. So we need to think about systemic amplifiers, which might also pop up along the way and create challenges. Next block was about macroprudential policy options which follow. And you had the rationale we presented in terms of market failures, but also the strategy. What would be a robust strategy you could scale up if you wanted to deal with climate-related risk? And how could you operationalize that based on current instruments? And there are some promising instruments in the set today. Without further adaptation, we could employ systemic risk buffer. We'd have also borrow-based measures, concentration limits, and also this latter approach to insurance protection gaps, and of course, much of the work on data gaps underway. Lastly, this look at nature, there's interrelated aspects, and of course, as ecosystem services tend to be also ones we're seeing higher exposures than we may have expected. With that in mind, Ernest, I know it's been a lot to cover, but I think I pass back now to Irene and Pierre to also make sense of all that I've said. And look forward to their comments.
Thank you very much, Paul, for this tour de force. You saved us all reading the substantial report, I suppose, to some extent. May I now invite Irene to give your comment?
Yeah, so thank you so much for the very comprehensive and clear also explanation of the report. So I did not prepare slides because I wanted to focus on three major points related to what you mentioned, and also open the points to the discussion. So the first point is that indeed exposure is not risk assessment, but it's absolutely important, because without a proper assessment of climate risk exposure, then we have a poor assessment of financial risk. So in this regard, I have three points which are connected to what you presented. So the first very interesting point that you showed is that somehow the loans intensity of emission is much higher than in the euro area, is much higher than the economy, despite we know that in the recent years after the COVID crisis, actually even emissions recovered in the economy. And this somehow, it's quite interesting because in finance, I mean, I might represent the academia here. In finance, there is a growing body of research showing that banks are pricing climate risk, but they are pricing emissions mostly. So this is quite interesting to see that instead, when you take a much broader and more comprehensive set of data like the ones that you have at the ECB and also on loans and loans characteristics, actually the results could be very different. And of course, this is relevant for then understanding whether to act, if we or policy makers have to act and how. But this connects also to the point that, okay, there is still so much to do about data collections of this of the exposure. You presented the results based on exposure based on emissions, which are relevant for transition risk, but are only one part of the story, which is somehow limited and backward looking, because what the scenarios that we use then for risk assessment, like the network for green financial system climate scenarios, focus on are not only emissions, so you have an emission target, but you have in particular, you have trajectories of energy technology output, so highly granular and divided between renewable energy sources and fossil fuel sources. So the energy, we should really start collecting information. I mean, at least authorities should start really collecting information on the energy technology profile of firms. And this, in order to be able to assess the forward-looking dimension of climate risk exposure of firms. And on the one hand, this is not impossible to do, because the usual question, the usual comment we get in finance is, okay, there is a reporting fatigue to which investors are exposed. They have to report on everything, on the EU taxonomy and so on. And then usual comments about, okay, then crowding out from the EU market because there is growing reporting needs. Request. It's not impossible to collect information about the energy technology profile. There is a growing body of information available, and it might provide also complementary relevant information for understanding both the market pricing and the performance of firms. And indeed, in a recent article that we published 1 month ago, we showed that we found that investors indeed actually reward in the long term firms that invested early in green energy technology. So there are long-run returns and overperformance of companies that invested in green in the stock market. So this might be also a signal. This would, including energy technology information of investments, could also tell you something more about how investors are moving in the condition of climate and the pricing, and also would complement with a forward-looking dimension the emissions dimension, where we know that, however, the big elephant in the room when we talk about exposure is that on the one hand, we have indeed kind of potential reporting fatigue, but on the other hand, we still don't have full standardization and quality assurance of reporting, meaning we still lack an supranational checking about the quality of reporting. And this, and of course, this has major implications both in, not more simply will be about, okay, thinking about greenwashing, but also about what type of information then companies give to investors and to the market. And also the need, of course, for then financial regulators in case investors are exposed to companies, So that's, I think, an important point. So combining the two dimensions of of information of emissions and energy technology profile would allow you to detect where inconsistency emerge, because if a company reports great improvements in scope 3, for instance, in transport, but then it has not increase its investment in energy technology vehicles, then you can see the inconsistency. But on the other hand, this is really there is really the need for supranational authority to check for the quality of information. And again, about reporting, we still the other smaller but still very important elephant in the room is that we still so far it just covers large companies. So in this regard, your results might be really conservative in terms of exposure. So this is about data and what could be potential useful addition to the analysis of exposure. And this is for transition risk. While we know that for physical risk, there are other dimensions that matter. So it's not only the carbon, not much the carbon intensity or the emissions per se of a company, of an activity, sorry, but the location and the level of investments in adaptation. And this is these are the other two major points on which we need better information and on which financial supervisors could really push to have better disclosure of information. Because again, when you talk about, for instance, asset level geolocalized information, most of the people in academia and finance say, oh, but information is not available or it's very hard to collect. So in a paper that we published 1 year ago, we showed that actually it's possible to collect and standardize this asset level information in a way that can be fruitful to everybody. So this is what we did. So the information is available, it's just scattered through different data providers. So the point, and this is, the good news is that to quite important extent, the information for physical risk assessment is available. But again, the other point is, okay, how do we enforce standardization and for reporting? And again, even here for physical risk, it's super important to have the role of financial supervisors that then use this information for financial risk exposure and risk assessment to have them on board. The other point that I would like to cover is that why this matters also. So the last point on why exposure matters is for risk assessment. Indeed, and this connects to also to the scenarios. So the major issue that we found so far is that no matter is how big, how damaging are the climate scenarios, then when we look at the translation of the disaster, for instance, for acute physical risk of the disaster's impact in on finance, then we find a gap. So we find it's like a mountain gives birth to then a small mouse. And so while we would expect that like events that have, or disasters that have a 1 in 100 years return period would have a large impact on investors that are exposed to companies and activities which are affected by the disasters, we still don't see it in the portfolio risk measures. And the two major problems here are, on the one hand, the data reporting, in this case, for instance, for physical risk, because we've found recently that staying at the firm level versus asset level dimension leads to underreport losses from acute physical risks, so disasters, of over 80%. So it's a lot. So this is why it matters to collect this information. And this means we lose a big part of the losses. And the other point is that this information then feeds into the macroeconomic models that even still shrink this this result, because most of them work on a setting based on rational agents and forward-looking information, which actually in the end leads to reduce the extent of the magnitude of the shock, for instance on GDP, because agents anticipate the shock and thus adjust much faster in the model than what would be then in the reality, also because models usually don't have credit constraints or actually this time delays in reactions. So these issues affect the way in which we do risk assessment and in which we do, in particular, the scenarios that we use. So it will be interesting to know from you, since you are a user of the Network for Green Financial System scenarios, what are your expectations and your points on these regarding the new short-term climate scenarios of the NGFS? And I would have a lot of other points, but I think on the discussion between and of course, I mean, all these feeds, and then give an assist to Pierre about the discussion on do we need to raise capital or we focus on concentration. That's but I think Pierre will discuss them.
Thank you very much, Irene. May I now invite Pierre for your comments?
You know, as a preamble, after seeing the numbers that Paul shared about global warming, I mean the physical measure. As economists, we are used to talk about fiscal and monetary dominance, but I wonder if we're not entering a climate dominance area where climate will impact all policy fields, including macroprudential policy. And that's what I would like to discuss. Let me just share my slides there, and you can tell if you can see them. So first, congratulations to Paul and his team for this report. It's a wealth of information, and not only for this report, but also for the 4 reports, yearly report that preceded that. I think the ECB has given us a lot of information to everyone, and I really recommend you to go through these reports. They are full of indicators that really, I think, makes the ECB one of the central banks that understand the best climate risk in general. So what I just want to tell you what I have learned from these reports and what are the consequences from a good macroprudential policy, and then dwell a bit on the systemic risk buffer that Paul also alluded to. So to be very short, I think what do we know about climate risk and financial stability now is that climate risk are potential systemic risk. So I think not only the ECB is saying that, but other financial supervisors. It's a recognized fact. So there are potential systemic risk. What we also know in general, and I think Irene alluded to that, is that climate systemic risk are likely to be underestimated with the measure that we have. The FSB and ESRB, for example, say that in climate scenarios that we have, conceptually we are underestimating climate risk. And what is key in terms of financial stability is also how these climate risks will unfold. There are several scenarios that are possible, and we don't know how, when, and in which form they will materialize. But this question is actually matter a great deal for whether we will have financial stability or instability. And I think central banks also agree, and Paul said it, that the best scenario for financial stability is an orderly transition starting now. That's the scenarios that minimize systemic risk. And if we have this scenario, climate risk looks like they are manageable. Like the flip side of the coin is that an orderly transition does start now front load transition risk. So we will face transition risk first, which is also something that supervisors have to consider. So when you say that climate risk are potential systemic risk, the natural answer for a financial supervisor is to say, if there are systemic risk, we need an adequate macroprudential response. And here Paul presented what the ECB thinks about what a good macroprudential response is. I share his view that it should be a holistic response, looking at not only banks, but insurance and other sectors of the financial system. It has to start with a sound macroprudential policy, but microprudential policy only is not sufficient. There are also systemic amplifiers of risk that are highlighted in several of the reports, and that kind of bring the need for macroprudential layer in the supervisors. And the existing, the systemic risk from climate are in several features very similar to other systemic risks that supervisors are used to know. So the toolkits that supervisors have now, the macroprudential toolkits, in that sense, can also be deployed to address climate systemic risk now. So a lot of the tools, including systemic risk buffer, are already existing and have been deployed for other risks. They could also be deployed for systemic risk. Although there might be need to adapt those tools to also reflect climate, like the unique feature of climate risk. And for me, I think in general, also macroprudential policy now aims at two things. First is to increase the resilience of the financial system. So it's kind of be resilient, can be able to absorb the shocks. But another important part of a good macroprudential policy is to mitigate the buildup of systemic risk, so which I call a containment component. And that, for example, is at the basis of counter-cyclical buffers. And that, I think, is also an important feature when you address climate risk. So let me just focus on one tool that I like, the systemic risk buffer, a capital tool. And Paul has shown that, you know, with the prospect of facing more shocks of higher intensity and frequency, there is also a need for banks to be better capitalized. So systemic risk buffer, a capital tool, is very adequate for me. And for me, a good systemic risk, and also, you know, systemic risk buffer is a tool that is already in the legislation of the European macroprudential framework. So it's not something that we have to introduce. It can be applied directly. Supervisors have used it for different type of risks at the national level, at the European level, and different types of risks that, in my view, are quite similar to climate risk in terms of financial mechanisms. So I would base a systemic risk buffer on three principles. First, there should be a component to absorb physical and transition risk, so that the absorption component that I was talking about, and this can be a function of individual exposure or systemic risk exposure. Paul alluded to this kind of difference that we can make, the granularity. But I would also add that in addition to an absorption vision of climate risk, we should also aim to mitigate the buildup of climate risk. And mitigating the buildup of climate risk means basically supporting the transition, because it's through a transition starting now that systemic risk from climate will be the lower. So a smooth transition, that's the best scenario for systemic risk for financial stability. So in that sense, if you want to avoid a buildup, then you should also, kind of design the tool to support the transition, which will reduce future systemic risk. So I think a good tool would have these two components, absorption and containment. And I would add a third one, which is kind of a dynamic adjustment, because depending on which path we will go, if we have a transition starting now or if we have a late transition, then the systemic risk reserves should adjust and reflect the risk that are associated to each of these transition. So I just try to do a blueprint of that. So as I just said, I think there should be one absorption component, which is more capital to absorb shocks, and that could be across the system or firm specific. I have a preference for firm specific because that would address the risk actually where they are, and that would limit the capital, the total of capital added in the system. And then there should also be a containment component, and that for me is this component is a function of how each individual firms, banks are contributing to increasing or decreasing systemic risk. So how they are contributing to make the transition more likely. But they should do that not just for the sake of the transition, but because that's linked to actually future risk. And then you would have a firm specific buffer, which reflect also this contribution. Again, also the dynamic point, we have an absorption component now. If we have an orderly transition, risk will decrease. We can decrease the systemic risk buffer. If we don't see a transition in 3 years, we might think of increasing because risk for the system will also increase. I will, very quickly on implementation. A few principles. There is a link to make with concentration risks, obviously. That could be also added in the kind of the absorption part. The Basel Committee put forward a marginal conservatism principle for climate risk. So we know that we are missing it with errors. So we're better to be on the safe side and add some margin of conservatism to our estimation to implement it. We could also think about deploying this tool progressively as data and experience develop, but I think we should be open to a try, evaluate, and adjust approach to start now. It's going to be difficult to have a very precise calibration, so try and see, and that requires some tolerance for potential errors. And ideally, in order to treat a level playing field, we should have international coordination on that, but that's not necessary. In Europe, each national supervisors can, I think, implement a systemic risk buffer at the national level if needed. But obviously, it would be better to have a coordinated effort toward that. Thank you very much.
Thank you very much. I think we have quite a few interesting questions in the chat meanwhile. And I will try to do justice to just a few of these questions. And then I would invite Paul, Irene, and Pierre to react to the questions, and Paul, of course, also to the comments made by Irene and by Pierre. So the questions in the chat included the following. Laura Treimane asks Paul, which of the mentioned macroprudential instruments and tools are the most complicated to implement right now? One question. A second question by Stefan Kavan from the ÖMB is, given that we still face large data gaps and the ECB's own data is often only experimental, isn't it a bit early to already discuss macroprudential measures when it has not yet been clarified whether the issue is a threat to financial stability? And the third question that has been answered, asked is, how is climate change quantified in economic terms? Does the ECB refer to any specific climate change measurement model and accordingly establishes some kind of economic quantification of its impact. Then Juan comments that the key word in Pierre's slide on the systemic risk buffer blueprint is calibrated. So it's very uncertain how much more than in the non-climate scenario. Anna Lalor, you touched on tipping points. How have you, or do you plan to include these in your risk assessment? And then a final question by Mikola Markusen. With the greening of monetary policy and ECB supervision, what additional goals will macroprudential measures achieve? How can we shift the focus in the euro area policy towards investing for the transition, which is ultimately the best protection?
So let me do my best to tackle these. I think I heard basically 5 points in here, and I'll try that you listed out, Ernest. And I can also couch maybe in terms of what I heard from Irene and Pierre, which is always, as usual, very insightful. Some of the elements too. So I think the first question block was this complicated. How do you tackle this complicated element? What would be the most complicated things to implement? I think for us, what's true is we try to lay out the types and the strategy of Macropru and also the framework for climate financial stability risk, the type of organizational thinking we have, which can be populated with time as we learn more. And we are still learning as we go along. No? And I think the complicated elements for me would be there are forward-looking aspects are very important here. So it's not just about how much you emit today, how are those emissions being brought down? And to be fair, we don't have transition plans yet, which are sufficiently informative. So Irene had asked about data gaps. For me, the key data gap is the forward-looking one. We have a lot in tow for firms. The CSRD, it's already coming into force in a phased manner, proportional also in terms of large, small firms, some elements of extraterritoriality. You have the Pillar 3 requirements in banks, and of course you have what's happening on the side of markets for the articles related to the classification of funds. So a lot is happening in that space, but it's going to take time to materialize. So as we pick things up along the way, I think the key one, which to me is still a missing bit, which we need to really add on, is transition plans. What metrics, what targets, how do we hold firms also accountable for bringing down emissions with time when they're particularly high, either financial or non-financial firms. And I think there's that element, plus this idea of climate-specific risk groupings. How do we identify those which are not broad brush sectoral allocations? Keep in mind, credit rating agencies, we didn't talk about much today, but are likely to benchmark to best in class. So it's not going to be about broad brush downgrading entire industries, but the leaders in industries. I think we can learn a lot from, and this is what we're doing in banking supervision side, looking at who are the banks in terms of taking a leading role, and how is it also helping us understand what types of challenges or benefits or costs you have in terms of transition dynamics. So clearly, that it is complicated, but I think we're managing to tackle some of this. 2 was on, I think the second question was about macroprudential readiness in scope, given these data gaps. I think, to be fair, we first and foremost, I maybe didn't make that clear enough, climate-related financial risk is the remit of prudential policy. It's not to replace or act as a surrogate for missing industrial policy. That's the role of elected officials, politicians, and industrial policy people. Now, with this in mind, still, I think in the space of managing the prudential risk, you can think at least about a few things. I mean, one is, effectively, we've been trying with these reports to prepare the ground. So there's a question, are we not jumping the gun? I don't think that's the case. To put out our thinking, have this type of dialogue, helps us to also refine and also improve, I think, the ways we're thinking in the scope to apply macroprudential risk levers to also contain this. So in a sense, it's about this incremental communication with the roadmap that we've been trying to establish along the way, instead of waiting until 2030 when we have the ultimate sort of, if you will, approach, which is canonical, but maybe a bit late. Let's keep the dialogue going. We're learning as we go along. And here, of course, what we are planning to do at this stage is take these frameworks for standing risk discussions and to also integrate these into the discussions. What are the relative risks associated with climate compared to other standing conjunctural risks, and how do we manage these? And also the relative merits of policy, if you will. Keeping in mind what Pierre said, there's type 1 and type 2 errors like there is any time under uncertainty. If you wait for the calamity to materialize, it's going to be too late. And the irreversibility of climate change is key. You know? If, on the other hand, you take measures which may be obviously knee-jerk reactions, too fast and lose credibility, and also maybe do things that weren't necessary, that's also a problem. But of course, we're not looking at extremes of type 1, type 2 errors, but obviously to try and balance these out. You know? And keeping in mind, we do have a preventative approach in Macropru, which should be also catered for. The third element, I think, in terms of economic quantification, it actually fits in with the complicated stuff initially. But just to say, stress tests have been a key focal point for us to better understand forward-looking risks. Of course, there's parallel work on the economic side in terms of it's a rich literature, and the channels are multifold. So on the economic side, the IMF, the ECB has also been looking at these types of economic elements. And to be fair, I don't think in looking at this, you will find a single model, particularly when it's Lucas critique, robust Lucas critique. You need to think about a suite of models to look at climate risk. It's complicated, of course, but it's not intractable. And we've been obviously publishing as we go along, learning, helping to also frame the debate in terms of numbers, measurement. Fourth, on tipping points, of course, that is an issue we are struggling to grappling with. Is, to be fair, it's not just us, it's climate scientists. So climate scientists themselves have difficulties quantifying tipping points. It's, to be fair, we've not seen these before. And so in a sense, I think it's to be aware of these as a potential aggravating aspect. But to be fair, I don't have yet numbers tied to that specific element. Climate scientists themselves also struggle with this. But it's an important one to be mindful of. Again, bring in the realm of going out of, if you will, nighting uncertainty. We don't know anything about this, to probabilistic risk. We can at least attach probabilities with that type of thinking. Lastly, this, I think the question, Michela, always thought-provoking on her side, and thanks for that. We've got Macroprudential, we've got monetary. What's left for Macropru? I think it's a good question. Of course, it's the traditional question I could even take outside climate and put in Macropru space. What is missing from what we look at individual safety and soundness of institutions? And of course, when it comes to the monetary anchor, what we're doing on that side, it's probably going to be about externalities, elements system-wide, which are not catered for by standard microprudential approaches. But in all contingencies, and I would not suspect in any way say that micro or Macropru should be at odds completely. They should be complements. So I think it's just an idea of adding to the Macropru dimension. What might you be missing with the system-wide aspects, one hand, and two is the horizon might be a little bit longer for Macropru because you're looking at financial cycle horizons, which tend to be a bit longer than economic cycles. Keeping in mind you only had 9 minutes, I've used a lot. I pass back to you.
Thank you, Paul. Irene, opportunity for 2 minutes of comments. Your mic is off.
Pardon. So basically, just a few comments on these last comments. So yes, there is true, there are plenty of macroeconomic models that you can use to feed the financial valuation, and really we can even in this case we have many more problems probably to discuss than the Lucas critique. Even Lucas in the last years said he was even his theory was not really consistent with himself. So let's moving really on the practical side. I think that we really need to start to understand under which conditions we can different characteristics of models, and in particular assumptions and structure, can lead to different results or explain why we get certain results. And really, it has been years saying this, but it's really more relevant now, going on in a comparative approach and sensitivity analysis. It's really even more important now. Then on the other hand, just some probabilities, just to clarify, to avoid confusion. So the probabilities you were talking about are not probabilities of occurrence of scenarios, because as clearly explained by the IPCC and the process-based integrated assessment model, so just to avoid confusions, scenarios are not forecast and they cannot be assigned to specific probabilities because of the uncertainty and endogeneity of climate change. But the good point for those of you who want to move from use scenarios for financial valuation adjustment and then financial risk pricing is that under specific conditions, so why you need to assign probabilities to the scenarios is then for the valuation, but under specific conditions, and this has been also proved mathematically, so the risk neutral probability can be approximated to the real one. So we would have, in particular, under conditions, assumptions of rational expectations, which then withstand the most of models we use. So this could be also a way of solving the problem of need to attach probabilities.
Thank you very much, Irene. Last words for Pierre.
Yeah, just quickly want to come back on one question about calibration that has been raised. So as Paul said, I think calibration must rely on forward-looking measure, and in that sense, the best forward-looking measure that is almost available now is transition plans, and it's quite worrying to see that the resistance supervisors face when they want to ask for transition plans, because I think without them they will be lacking an important information about future risk. So that's one point. When I was talking about also contribution to the transition, I don't mean emission by that. It's a bank can contribute to the transition in many ways, supporting clients, having good transition plans, getting out of fossil fuels. So that's kind of how you could calibrate it. Now, if in terms of purely calibrating numerically, I think that two important principles was, of course, it's very difficult to say an exact number, also because we don't know exactly what we want to achieve with this exact number, except that we want the system to be more robust. But my own experience from the past from implementing countercyclical buffer, when you increase countercyclical buffer from 0.5% or 1%, it's also a bit of testing the water. You don't know exactly what you want to achieve. You have a rough sense, so it's always a kind of a political decision. And there is probably a need for kind of try, error, and adjust, as I wanted to say. But I think it's possible, and then there is these precautionary principles that I think it's important, in a sense that we are likely to, with the measures that we have now, we are likely to underestimate climate risks. So there is a margin of conservatism to have on top of a precise estimation anyway. So yeah, I think that's, it's possible to implement a level without knowing exactly the risk level to the third decimal.
Thank you very much, Pierre. This concludes our webinar on macroprudential frameworks for managing climate risk. I think we got a glimpse into key issues at stake. For those more interested in details, please have a look at the ECB's report, which is also linked on the SUERF website. Thanks a lot to Paul, Irene, and Pierre for your excellent presentations and comments. Thanks to all for participating, for your interest, and for your very relevant questions. With this, let me conclude this webinar. Bye-bye, and have a nice evening.
Bye-bye.
Thank you.
Thank you. Bye-bye.
Bye-bye.
Thank you.